One simple and inevitable change has caused chaos in the markets, and today's video we are going to look at what's happening with real estate, and the second thing I want to talk about what's happening with stocks. I'm going to connect these two things together with one simple action that's been happening on a global level. Do you know what it is? Well, let's begin. All across the world, there's been one common theme, and that has been high inflation. As a result, central banks have needed to increase interest rates. During this period of time, of course, you have stricter borrowing, you have more debt, and all of that really coming to a head right now. People are in circumstances that they've really never been in before because of all that debt. Added on top, you look at this interest rate that hasn't been there for a very long time. The two just don't work together and you have a crisis on your hands. Well, in the case of Spain and many other places, they've announced a $10 billion package to ease the inflation pain. But where does this money come from? Well, you look at all of the different stimulus packages and it comes from the taxpayer. That's the facts, okay? So the taxpayer has to pay for it, so you will pay directly or you'll pay indirectly. But of course, people are gonna say, sure, I'll take it. If you're gonna give me a check, I will take that. California has done this, other places have done this, where they're trying to ease that pain, but at the same time, what they're really trying to do is keep people from going crazy on the streets. That's really what this is about. You have to make people believe that what's coming won't be worse than what's already here. That's what they're trying to do. And they're just saying, hey, don't worry, we're taking care of it. Everything is going to be fine. But with these high interest rates, it's very difficult for some to believe that. And when you look at this as the Fed funds rate, showing us that they've been increasing rather quickly compared to at least what they've done in previous cycles. And this has been going up to levels we haven't seen before. And like I said, with all that debt, it spells trouble. A lot of people did not think this would happen. And of course, this affects different industries. One of those that I believe are loving it, Wall Street's big banks score $1 trillion of profit in a decade. In a decade. They've made $1 trillion in profit, and you see how many companies there are. They employ a lot of people, but as soon as their profits take a hit, well then, they do one thing, and that is they increase their productivity. Do you know what I'm talking about? Right. They fire people. And many of the banks have done that, tech companies have done that, and you look at this at a time in which you're seeing their profits doing very well overall. Depends on the company, depends on the circumstances, but they're not going to really take a hit on their corporate profits during this period. High interest rates, if positioned properly, and depends on our investment banks and commercial banks, all different stories, but they have the opportunity to make more money than ever before. Not always is this the case for people who are, let's say, borrowing on their credit cards. They're going to get hit harder because now interest rates at 19%. Maybe some of real estate investors are going to feel the brunt of this as well. And let's look at that data right here and now. Are you interested in real estate data? Are you interested in real estate information? I've got several charts right here to show you, okay? 1 year price change percentage by metro area, February 22 through October 22. And you can look at that, Tampa, right on the top of the list, seeing where this has gone. Some areas did not go to extreme lengths as we had seen before. You could see it month to month where this has been, and it's clear as far as I'm concerned that things are slowing down. Okay, we look at the month over month and we see that trend. Interest rates have been rising. In some cases, we're seeing inventories climbing as well. In many cases, in fact. And this just shows us the home prices. On a month over month basis and year over year basis, they have started to decline. You can look at this in one area and say, no, that's not true. It really depends on where you are. But in general, this is the direction they're moving. Now that's coming off the peak. And that peak was a very high one. We're talking about a Mount Everest type of peak. And then we just compare that with the mortgage rates. And while you could see that right there, mortgage rates, really peaking out just over 7% and have come down the way that's, it's inverted in this sense. But what we're looking at is a very high level of what most people are unable to pay. at the time of this recording, it's in the sixes for mortgage rates, but that depends on you. It depends on your credit. It depends how much debt you've currently taken out. There's so many factors, but it's in that range, 6 to 7% right here. And certainly a lot of people can't afford that. So it has an impact on everything to do with real estate. I've got lots of data to show you, in fact. Did you know that building permits are one of the best indicators to look at? I did talk about this in my first book, and you got to pay attention to permits. You got to look at vacancies as well. These are two very important stats. Let's look at them. Here we have it. You can see private housing authorized by building permits. That's the blue line. And those have come down as well. In addition, we have owned housing units started by structure total, just showing us how much of the building has taken place today. So the permits as well as builds, and they've both come down in lockstep as they usually do. Is that really something that you should be surprised of? No, absolutely not. But this has an impact on inventory. Inventory is very important, okay? Some areas don't really have that much inventory in, let's say, a desirable area that's near a good school, that's close to transport and all that. And so if there are less buildings coming up, that can kind of keep the prices supported. So just remember that. Housing permits, you could look at that, same situation. I thought it was interesting, multifamily as well have declined. And that's the simple matter of fact is when you increase interest rates, you slow stuff down. That's a matter of fact. But the multifamily, if you're talking about places that have 100 rental units in one, 50 rental units, maybe even more. And these places here are the type that would see a big, a big increase in the amount of people moving in. They can't afford the house anymore. They're now going to rent. And if multifamily permits are going down, that just makes the existing pile higher rents as well. So we got to watch out what happens here in this level, looking at pending home sales declining substantially. Okay. This is unbelievable. You look at that on a year-over-year basis. This chart goes all the way back to 2000. Haven't seen anything like this. Can you believe that? Pending home sales. Then we have new mortgage borrowers could end up paying thousands more for a home loan. I think that is pretty clear. But when you increase interest rates to this degree, you're going to have to potentially deal with that at some point. Yes, you got the new people coming in, but also for those refinancing, they're going to be in trouble. You see that high numbers of homeowners are set to refinance their mortgages in the coming year, but some may find themselves paying tens of thousands of pounds more over the course of their new home loan that they would have done if they'd taken out a deal just a year ago. This is for UK, obviously. Bank of England raised increase over the last 12 months, pushing up borrowing costs. Mortgage rates jumped in the wake of the mini budget, with many deals also being withdrawn. This is variables affected by this directly. And then you have people who, depending on where you live, if you're in Canada, for instance, you are required to basically refinance essentially every 3 to 5 years, depending. And that hits people hard. So this is going to hit other countries, not just the US. Home prices slip for the fourth month with the US market slowing. Affordability declines. You see this for home flippers as well. That was a big business for a while. So many channels, Home and Garden TV, HGTV, they've got home flipper this, home flipper that. It gives people this idea that they can do the flips, and that works if the market is continually going up, but it really struggles during these times, and that's why home flippers are kind of saying, no thanks. Investors as well. I'm going to actually talk about that in the breakdown section, so let's look at that in a second. Home builder sentiment dropped for the 12th straight month, a whole year, every single month. Why? Costs are up and people don't have the same desires they did before. But a bottom may be near, that's what they're saying. We really don't know. It depends on mortgages. Really, really depends on mortgage rates. And that's really key. So according to Warren Buffett, his favorite housing metric just flashed a major signal. And according to the Oracle of Omaha, said in 2010 that sometimes a bad number for housing starts is a good thing for the market. In this case, he was referencing a cool housing market in which supply outstripped the demand. The only way to solve it was create more demand than supply by reducing the number of newly built homes. So like I said, I just talked about this a minute ago. if you had looked at what happened with the housing permits, we need to address that. We need to look at inventories as well. So I'm going to follow that data. If you want to know about that and you want to really get a good eye on what's happening in the mortgage, housing, what's happening in multifamily, single family, all that, hit subscribe. I'm going to bring that information to you as we move through this cycle. Hit subscribe right now. Let's go on to the breakdown section. I'm going to explain this in depth. As interest rates rise, real estate investors tend to stop deploying more capital because higher interest rates can make borrowing more expensive. This can especially be true for real estate investors who rely on debt financing to purchase properties. When interest rates rise, the cost of borrowing increases, which can make it more difficult for investors to afford the debt payments on their properties. This can lead to a higher number of delinquencies as investors struggle to make their payments. For example, during the 2008 financial crisis, many real estate investors were negatively impacted by rising interest rates. As the crisis unfolded, the Federal Reserve increased interest rates in an effort to stabilize the economy. This caused borrowing costs to rise, which made it more difficult for real estate investors to afford the debt payments. As a result, many investors experienced delinquencies and even defaulted on their loans. Overall, as interest rates rise, profits for real estate investors tend to shrink. Higher borrowing costs can decrease the profitability of rental properties as investors may be unable to pass on the higher costs to tenants. Additionally, as vacancy rates increase during recessions, the income generated from rental properties may decline, further reducing profits. Now, I understand for some people, they say, well, who cares? Who cares about the landlords? Who cares about all of those out there who are making profit off of this? But we must understand that sometimes we do need people to get out there and actually build new stuff, new buildings, small ones, single family homes, multifamily, places where we can live. So that's important to note, okay? Then we look at what's happening in the stock market. These are directly correlated by that one thing. I told you at the beginning, what's that one thing? Interest rate rises and, more broadly, the policy set by the central bank, the Federal Reserve. Tesla's 2022 collapse hit 69% after deepest sell-off since April. You've been watching this particular stock. I'm seeing it in the news every single day. All I'm trying to highlight here is that when we look at these extremes, they usually come back down to earth during the cycle, and I've been highlighting that for literally 10 years now. This is the stock at this moment. I mean, who knows by the time you're watching it. All I'm trying to show you here is that things can get real wild. Okay, I think it's important just to look at it because this was the one that was going so crazy. All the degenerate YouTubers who were pushing this to a great degree, we're really stressing how everybody needs to go all in, mortgage your house, do anything you need to do. But a lot of people have lost their shirts on this, perhaps been margin called by this, and they're not saved by their other investments either because they're not doing well. So the point here and the moral of the story is you have to pay attention very closely to the Federal Reserve, their actions, and so on if you want to be a good investor. That's the way it goes. You can't just dollar cost average your way through or you will be burned. You can ask Kathy Wood if you'd like to. You can maybe send her a message on Twitter or something. Kathy Wood feels investor pain, foresees gains. Don't worry, she foresees the gains. I mean, this is just crazy because she's a huge investor in Tesla, saying that, you don't need to worry. These times right now are tough, but it's going to get much better. I know that the stock has lost basically all the value no matter when you invested in it throughout the period, but just hang in there because gains are coming. I mean, it's just really sad. Like, I'm not saying anything about this particular individual. I'm just trying to highlight you cannot fight the Fed. I've heard that comment 1,000 times on my channel before. And yet when things flipped around, I see how that comment disappeared, along with the people, by the way. They were not happy. A lot of people were not happy with me that this cycle ended up the way it did. And I see that. And they left. And that's sad because that's what a child would do. And this is just talking about Disney, saying that, okay, they brought the old CEO back in, the stock had popped, and then, things are not so good. I mean, there's so many reasons why this is the case. You cannot fix a company overnight, and you have to actually realize that companies just can't get bigger forever. They have to evolve, they have to change. This could be any company. This could be for ones that have been established for over 100 years, and not everything lasts forever. And that goes for you as well. When you look at the way that you invest, you can't just do the same thing all the time, every single day. We must be smarter about this. We must be more intelligent. And I'm going to bring you new information each and every single day. All you have to do on your part is hit that subscribe button. It's right next to the like button. So make sure you hit that subscribe. And each and every day, I'm going to bring you the little nuances you need to know. I'll explain it as simply as I can. Any comments down below, I'm going to be able to actually see those, and I'll know what you're thinking. We got to share this information right from the grassroots. See you tomorrow.